$6 trillion returned to precious metals in just 48 hours. Gold up 15%, silver up 26%, the largest recovery since 2020. But here's what they're not telling you. While Western markets celebrate this rebound, Chinese bank apps are crashing, buyers ready to purchase, locked out completely. And in the same 48 hours of this recovery, nearly 6% of physical silver vanished from vaults. 2 million ounces, gone. During a price surge, physical disappearing, while paper recovers, access restricted, while demand explodes. This isn't a recovery, this is something else entirely. And what happens next will redefine how wealth is stored. Welcome to John Analyst, a space built for those who understand that financial literacy isn't optional anymore. It's survival. Now, a small request. If you've seen a few economic cycles, if you remember when information wasn't instant but required patience and careful observation, you'll appreciate what we do here. We don't chase headlines. We analyze patterns. Would you consider subscribing? Not for us, but because this type of analysis deserves an audience that values depth over noise. Hit that subscribe button the way you'd bookmark a page worth returning to, and let us know in the comments, where are you watching this from? New York, London, Mumbai, Singapore, Tokyo? Your location matters because what's happening in precious metals right now is global, but the impact is deeply local. Now, let's begin. It is Wednesday, the 4th of February, 2026, and the precious metals market has just experienced something extraordinary. In exactly 48 hours, from Monday's lows to this morning's trading session, $6 trillion has been added back to the combined market capitalization of gold and silver. $6 trillion. To put that number in perspective, that's more than the entire GDP of Japan. Returned to two metals in 2 days. Gold has surged 15.62% from Monday's bottom, adding $474 trillion to its global market valuation. Silver has exploded 26% higher, adding another $1 trillion. Gold prices have risen nearly $700 per ounce from their Monday lows, reclaiming the psychologically critical $5,050 level. Silver has jumped from the low 80s to $91. On paper, this looks like a classic V-shaped recovery, the kind of bounce that makes traders feel vindicated, that makes headlines scream crisis averted. But there's a problem, and it's not a small one, because while the paper price has recovered, something else has been happening simultaneously, something that contradicts everything these price charts are suggesting. The physical metal is vanishing, not slowly, not gradually, but at an accelerating pace that hasn't been seen since the chaos of early 2020. Let's examine what a $6 trillion recovery in 48 hours actually represents in market terms. Historically, precious metals don't move like this without massive institutional involvement. Retail investors, no matter how enthusiastic, cannot generate this kind of capital velocity. This is algorithmic trading. This is futures repositioning. This is options gamma squeezing higher. This is central bank level liquidity moving through the system. In 2020, during the pandemic uncertainty, gold took 3 months to add $3 trillion to its market cap. In 2008, during the financial crisis, it took silver 4 months to achieve a 25% recovery. What just happened in 2 days typically takes quarters to unfold. The futures market shows classic short covering behavior, massive volume, explosive price action, volatility indicators spiking into extreme territories. COMEX gold futures saw over 200,000 contracts change hands on Tuesday alone. Silver futures volume exceeded 3 times the monthly average in one session. Options positioning shifted dramatically. Put options that were deep in the money on Monday expired worthless by Wednesday. Call options that seemed ridiculously out of the money, suddenly valuable. This is the signature of institutional panic buying, or forced liquidation of short positions, or both happening simultaneously. Western exchanges, New York, London, saw record settlement volumes. The paper system, the derivatives market, the futures complex, all functioning exactly as designed. Liquidity appeared abundant. Bid-ask spreads tightened. Order books looked healthy. Every technical indicator suggested that supply had met demand, that equilibrium had been restored, that the worst was over. The narrative being constructed was simple. Markets overreacted on Monday. Smart money stepped in. Normalized pricing returned. Crisis contained. Financial media began running stories about buying the dip and resilience of precious metals. Analysts started revising their year-end price targets upward. The entire apparatus of market commentary shifted from concern to relief to optimism. But here's what none of that analysis accounts for. While paper gold and silver were recovering 15% and 26% respectively, Physical metal was moving in the opposite direction, not in price. In availability, the COMEX silver depositories, the warehouses where actual physical silver backs the paper contracts being traded, reported something unusual. On Monday, the same day prices bottomed and began their recovery. 2 million ounces of silver were withdrawn from the vaults. On Tuesday, another significant withdrawal. By Wednesday morning, registered silver inventory had dropped 946,000 ounces to just 103 million ounces total. That's a 5.9% decline in physical silver held in COMEX vaults during a 26% price recovery. Read that again. Price up 26%. Physical inventory down 6%. In traditional market mechanics, rising prices should attract supply, not reduce it. When prices surge, holders should be incentivized to sell, to take profits, to add metal back into the system. Instead, the opposite is occurring. The higher the paper price goes, the faster physical metal leaves the warehouses. This is not normal market behavior. This is not how supply and demand equilibrium functions. This is the signature of something structural, something systemic, something that cannot be explained by traditional price discovery mechanisms. And it's not just happening in New York. The divergence is global. Shanghai spot silver trading at $104 per ounce, while Western spot markets show $90, a $14 premium, 16% higher for the exact same metal in a different location. Arbitrage traders should be flooding this opportunity, buying in New York, selling in Shanghai, closing the gap. But the gap isn't closing. It's widening. Because this isn't about price anymore. It's about access. And that's where China enters the story. There's an old principle in commodity markets that most traders forget until it's too late. Paper contracts can be created infinitely. Physical metal cannot. And right now, while everyone celebrates the $6 trillion recovery, the physical metal is telling a story that contradicts every bullish headline. It's disappearing. Not metaphorically, not theoretically, but literally, ounce by ounce, bar by bar, from the very warehouses that are supposed to guarantee the integrity of the paper market. Let's go deeper into what happened inside the COMEX silver depositories during this so-called recovery, because the numbers reveal something far more significant than a simple price bounce. Monday, February 2nd, the day prices bottomed and began their dramatic reversal. Asahi Refining, one of the major depositories, reported a withdrawal of 35,000 ounces. Not unusual by itself. Withdrawals happen daily. But then Brinks, the armored transport and storage giant, adjusted out 1.1 million ounces from their registered inventory. Registered inventory, that's the metal that's available for delivery against futures contracts. The metal that backs the paper promises being traded. When it moves from registered to eligible, or simply leaves the facility entirely, it means that metal is no longer available to fulfill contract obligations. HSBC, 400,000 ounces withdrawn. JP Morgan, the largest single silver holder in the COMEX system, 1.2 million ounces gone. Total registered silver inventory down 946,000 ounces in a single day, from 103.9 million ounces to 103 million ounces. Now, some might say, that's less than 1%. Why does it matter? Here's why it matters. In March 2020, when silver prices collapsed to $12 per ounce, registered inventory actually increased. Physical holders saw low prices as an opportunity to deposit metal, earn storage fees, wait for recovery. In 2008, during the financial crisis, when gold dropped below $800, vault inventories swelled, sellers materialized, metal flowed back into the system. Supply responded to lower prices exactly as economic theory predicts. But in February 2026, the pattern has reversed. Prices drop on Monday, and instead of supply entering, it exits. Prices recover Tuesday and Wednesday, and supply continues exiting. This is the signature of something fundamentally broken in the price discovery mechanism. When lower prices don't attract sellers, and higher prices don't attract supply, the market is no longer functioning on traditional economics. It's functioning on fear. Fear that paper claims may not convert to physical metal when demanded. Fear that counterparty risk has entered the system. Fear that the next person to request delivery might not receive it. Now let's examine the granularity of these withdrawals. JP Morgan's 1.2 million ounce movement is particularly revealing. JP Morgan holds approximately 42% of all COMEX registered silver. They are not a passive holder. They are an active market maker, a key player in silver derivatives. When they move metal out during a price recovery, that's not profit taking. That's repositioning. That's preparing for something. Brinks adjusting 1.1 million ounces from registered to eligible or out of the facility entirely tells another story. Eligible inventory can be converted to registered if needed, but it requires paperwork, verification, time. In a fast-moving market, time is the one thing participants don't have. If metal moves from registered to eligible during rising prices, it suggests someone believes that metal will be more valuable outside the COMEX system than inside it. HSBC's 400,000-ounce withdrawal is smaller, but HSBC is a Chinese-connected bank. They have significant operations in Asia, direct access to Shanghai markets, understanding of Eastern demand flows. When HSBC moves metal out of New York, where's it going? The pattern becomes even clearer when you examine gold vault activity during the same period. Gold registered inventory dropped 2.3% on Tuesday. Not as dramatic as silver, but significant nonetheless. Gold eligible inventory, the metal not immediately available for delivery, actually increased slightly, meaning metal is being moved into storage categories that remove it from immediate market access. This cross-metal correlation, both gold and silver showing similar withdrawal patterns during price recovery, eliminates the possibility of isolated events. This is systematic, coordinated, deliberate. Now, here's where the story intersects with global arbitrage. Shanghai silver spot price, $104 per ounce. New York COMEX silver spot, $90 per ounce. Shanghai silver futures, $101 per ounce, a $14 premium in Shanghai, 16% higher than New York. In normal markets, this arbitrage opportunity would be immediately exploited. Buy 10,000 ounces in New York at $90, ship to Shanghai, sell at $104, pocket $140,000 minus shipping and insurance, maybe $120,000 net profit per 10,000 ounces. Multiply that across thousands of traders, millions of ounces, and the arbitrage closes in days. But it's not closing, it's expanding. On January 28th, the Shanghai premium was $8. On February 2nd, it hit $12,000. Today, February 4th, it's $14. Why isn't arbitrage working? 3 possibilities. 1, physical metal cannot be acquired in New York at spot prices, despite what the paper market suggests. 2, shipping and logistics have become so constrained that the cost of moving metal negates the arbitrage. 3, there are regulatory or access restrictions preventing the free flow of metal between markets. All 3 possibilities point to the same conclusion. The paper price is no longer reflecting physical reality. The futures market, the options market, the spot market in New York are all trading on assumptions of supply that don't exist. And the longer this divergence persists, the more dangerous it becomes. Because eventually, someone holding a paper claim will demand physical delivery. And when the warehouse says, we don't have it, that's when the system breaks. Not gradually, not with warning, but instantly. While Western vaults drain, Eastern access is being restricted. And that's where the next chapter of this story begins. There's a moment in every market crisis that historians look back on and recognize as the inflection point, not when prices collapse, not when volatility spikes, but when access itself becomes the scarce commodity. February 2026 may be remembered for exactly that moment. In China, on Monday morning, as gold prices dipped below $4,400 per ounce, something unprecedented occurred. Millions of retail investors, predominantly young buyers between ages 25 and 40, attempted to log into their bank applications to purchase physical gold, and the system simply stopped working. Not a gradual slowdown, not a temporary glitch, but a complete systemic failure across multiple banking platforms simultaneously. Industrial and Commercial Bank of China, China Construction Bank, Agricultural Bank of China, Bank of China itself, all reporting the same technical failure. At the same time, during the exact window when gold prices hit their lowest point in weeks. The official explanation? Large amount of money poured into banks to purchase accumulated gold, resulting in the inability to log into bank apps. Let's dissect what that statement actually means. Chinese banks offer gold accumulation programs, digital products that allow retail investors to purchase fractional amounts of physical gold, stored in bank vaults, redeemable on demand. These aren't paper derivatives. These aren't ETFs. These are claims on actual physical metal held in custody, or at least that's the promise. When prices dropped Monday morning, the behavioral response was immediate and overwhelming. Chinese retail investors who have watched their real estate portfolios collapse, who have seen their stock market stagnate, who have witnessed currency controls tighten, saw gold at a discount and moved decisively. But the infrastructure couldn't handle it, or more precisely, wasn't designed to handle it, or, most troubling possibility, was deliberately prevented from handling it. Because here's what makes this different from a typical technical failure. The banking apps didn't crash across all functions, only the gold purchase portals. Users could still check balances, transfer money domestically, pay bills, access other investment products. But the moment they attempted to convert yuan into gold, the system locked them out. This isn't the first time this specific pattern has emerged. In March 2020, when gold briefly dipped below $1,500, similar access issues occurred in China. In August 2011, when gold crossed $1,900 for the first time, Chinese gold purchase platforms experienced maintenance windows during peak demand hours. In September 2008, during the Lehman Brothers collapse, physical gold dealers in Shanghai reported being unable to process orders despite having inventory. Every single instance, the same pattern. Price volatility, retail demand surge, access restriction, delayed settlement, and by the time access is restored, the price has moved significantly higher. Who benefits from this pattern? Not the retail buyers, who were locked out at the bottom and allowed back in after the recovery. Not the banks, who face reputational damage and customer frustration. The beneficiaries are those who have access when others don't. Large institutions, state-connected entities, banks' proprietary trading desks, those with direct vault access rather than digital intermediaries. They can buy at $4,400, while retail is locked out, and sell back to that same retail at $5,050 when access is restored. This is wealth extraction through access control. And it's becoming more frequent, more systematic, more predictable. Now, let's examine the demographic of these locked-out buyers, because it reveals something about the future of wealth storage. The majority attempting to purchase gold during Monday's dip were not elderly savers protecting lifetime wealth. They were millennials and Gen Z investors, the supposedly digital native generation, the demographic that should trust cryptocurrencies and fintech more than barbarous relics like gold. Yet when uncertainty hit, when markets wobbled, when access to stability became paramount, they chose tangible assets over digital promises. They chose gold over tech stocks, over crypto, over government bonds, and the system denied them access. This generational shift is significant. Older generations in China have cultural affinity for gold. That's well documented. But younger Chinese buyers are making calculated financial decisions, not cultural ones. They're looking at real estate down 40% from peaks. They're watching regulatory crackdowns on tech giants. They're experiencing capital controls preventing foreign investment. Gold becomes the logical asset, the one thing that's genuinely scarce, genuinely portable, genuinely outside the digital control grid. Until the moment they try to buy it and discover that even gold, when accessed digitally, can be restricted. Now compare this to what's happening in Western markets simultaneously. In the United States, Canada, Europe, Australia, retail investors had complete access to gold and silver markets throughout Monday's volatility. They could buy physical coins from dealers, purchase ETF shares, trade futures, execute option strategies. No access restrictions, no app crashes, no settlement delays. The infrastructure functioned normally. So why the disparity? Why does Chinese retail get locked out while Western retail maintains access? The answer lies in what each system is actually protecting. Western markets are protecting price discovery, ensuring liquidity, maintaining the appearance of free markets. Chinese markets are protecting metal, ensuring that physical supply remains controlled, maintaining the ability to restrict access when demand threatens availability. One system prioritizes the integrity of the paper market, the other prioritizes the integrity of the physical stockpile. And here's the critical question that follows. If China, with the world's largest gold reserves, with massive domestic mining production, with state control over banking infrastructure, if China cannot maintain retail access to gold during volatility, what happens when smaller nations face similar demand surges? What happens when Western banks face the same choice between maintaining access and protecting physical inventory? The precedent being set right now in China in February 2026 is that access will be restricted when necessary. And necessary is defined by whoever controls the infrastructure. Young Chinese buyers aren't being foolish or naive. They're reading the system correctly. They understand that tangible assets are more secure than digital promises. What they're learning now, the hard way, is that even tangible assets can be made inaccessible through digital gates. The bottleneck isn't the metal itself. It's the permission structure around accessing that metal. Physical metal is disappearing from Western vaults. Eastern buyers are being locked out from purchasing. And the paper price is recovering as if none of this matters. But it does matter, because this pattern has happened before. History doesn't repeat, but it rhymes with disturbing precision. And the pattern unfolding right now in February 2026 has played out before, multiple times, across different decades, different markets, different currencies. But the outcome has always been the same. Physical disappears first, price adjusts later. let's examine the historical precedents because they reveal exactly where this current situation is heading. March 2020, the pandemic panic, gold and silver prices collapsed initially, not because demand fell, but because liquidity froze across all markets. Retail buyers rushed to purchase physical coins and bars. Premiums exploded from 3% above spot to 30% overnight. Online dealers sold out completely within 72 hours. Mints suspended production, refineries closed, logistics chains broke. But here's the critical detail everyone forgets. While physical metal became unavailable at any price, the paper market continued trading normally. COMEX futures showed ample liquidity. ETFs continued operating. Options markets functioned. The paper price said, everything is fine. The physical market said, nothing is available. This divergence persisted for 11 weeks. And when it finally resolved, it resolved through price adjustment upward, not through physical supply returning. Gold went from $450 to $270 in 5 months. Silver went from $12 to $30 in the same period. The paper market eventually acknowledged what the physical market already knew. Scarcity was real. September 2008, Lehman Brothers collapse. Gold dropped from $920 to $720 in 3 weeks, a 22% decline. Rational investors saw this as a buying opportunity, attempted to purchase physical gold coins and bars. The United States Mint, responsible for producing American Eagle coins, suspended sales entirely. Royal Canadian Mint, sold out. Perth Mint in Australia, 12-week delivery delays. Premiums on available physical metal reached 40% above spot price. Yet the futures market continued showing gold at 720 with tight spreads, normal volumes, perfect liquidity. The divergence lasted 9 months. Resolution came through price, not supply. Gold reached $1,900 by 2011. The paper market caught up. 3 years later, January 1980, the Hunt brothers silver squeeze. Silver prices spiked from $6 to $50 in 12 months, then collapsed back to $10 within 8 weeks. At $10, silver looked historically cheap. Investors rushed to buy physical. Dealers had nothing to sell. Refineries were backlogged for months. Industrial users began hoarding supply. The COMEX, facing delivery failures, changed the rules mid-crisis, increased margin requirements, restricted long positions. Physical silver remained unavailable for 2 years at any reasonable premium. When supply finally normalized, the price had stabilized at $35, not $10. The pattern is consistent across decades. Volatility triggers physical demand. Physical supply cannot meet demand. Paper markets continue functioning. Divergence expands. Access becomes restricted. And eventually, price adjusts to reflect physical reality. Not immediately, not smoothly, but violently and without warning. Now, let's address the common counter-argument. This time is different. Markets are more sophisticated now. Technology has solved these problems. Has it? Chinese buyers couldn't access gold on Monday despite having capital and intent. COMEX vaults are draining during a price recovery, exactly when supply should be increasing. Shanghai premiums are expanding, not contracting, despite obvious arbitrage opportunities. Technology hasn't solved the problem. It's created new vulnerabilities, because now access can be restricted with a single line of code, a system maintenance window, a technical glitch that's indistinguishable from intentional throttling. The narrative around smart money versus dumb money completely misses what's actually happening. Retail investors in China attempting to buy gold at $4,400 aren't stupid. They're responding rationally to systemic uncertainty. Real estate portfolios destroyed, stock markets manipulated, currency controls tightening, capital flight restricted. In that environment, choosing physical gold is the intelligent decision, the system failing them at the exact moment they need it most. That's not their failure. That's systemic design. Western commentators calling Chinese retail dumb money chasing tops fundamentally misunderstand the risk calculation. The risk isn't buying gold at $5,000 and watching it go to $4,500. The risk is needing gold at any price and discovering it's unavailable. And that's the trade they're making. Access over price, security over returns. And they're being proven correct in real time. Because while paper markets show recovery and stability, physical markets are showing scarcity and access restrictions. So what are the strategic implications for anyone watching this unfold? First, the $6 trillion recovery in paper valuations means nothing if physical metal cannot be accessed at those paper prices. Second, access risk is now a permanent variable in precious metals thesis, not a temporary disruption. Third, the Shanghai premium is an early warning system. When it expands during volatility, physical shortage is accelerating. Fourth, vault data is more important than price data. Watch what's leaving warehouses, not what's trading on screens. Fifth, China's exclusion during this cycle sets precedent for future restrictions elsewhere. The timeline question becomes critical. How long can paper markets trade at $5,050 gold, while physical markets show $5,200 in Shanghai, while vaults drain, while access gets restricted? History suggests, not indefinitely, the divergence always resolves. And it always resolves in favor of physical scarcity, not paper abundance. The current situation isn't a recovery. It's an intermission. The paper market has stabilized. The physical market continues tightening. One of these two realities will eventually force the other to adjust. And based on every historical precedent available, physical reality wins, paper adjusts. The question isn't whether this pattern will hold. The question is, when the adjustment comes, who will have access? And who will be locked out? February 2026 is teaching a very expensive lesson to anyone paying attention. Physical disappears first. Price adjusts later. That pattern has never been broken. And nothing happening right now suggests this time will be different